Even after today's bounce, this market's been absolutely awful. So bad that you can practically feel the negativity in the air. It's just hanging there. Stocks have been obliterated over the past 6 weeks, and you don't need to be a genius to understand why. We've still got rampant inflation, and the Federal Reserve has made it clear that they'll throttle the life out of the economy until prices settle down. Meanwhile, the rest of the world's in much worse shape than the United States. All in all, it sure feels like we're headed for a recession, doesn't it? So everybody's been selling because they want to get out ahead of all the estimate cuts that are going to start real soon when we get to reporting season. Now, we got a reprieve today because the bond market finally went in the right direction. But that was thanks to the Bank of England, of all places. The narrative remains overwhelmingly negative in this country. However, that negativity at times is one of the things that I like about the market. Stocks are really despised right now. Frankly, as hated as I've ever seen them. Honestly, it's kind of a little bit nuts. Think about this. Even if the Fed causes a fear recession, it's not going to be comparable to the financial crisis. Yet we're seeing levels of investor negativity right now that are comparable to the financial crisis, if not worse. Good news, right? Now, the market can't bottom until we have a ridiculous level of pessimism, until all the fair weather bulls throw in the towel, and there's nobody left to sell. Keep that in mind, right? Nobody left to sell. That's not the only thing you need for a bottom, but it is the most important ingredient. And right now, sentiment's gotten extremely negative. But we have to analyze why, what it means, and how you find it. So I don't want you to take this from me. We are going off the charts with the help of a guy named Ralph Vince. I mean, he's a brilliant technician. He's been programming trading systems for all sorts of funds since the early 80s. Kind of incredible grasp of the big picture. Hey, this is a guy who comes with the Larry Williams seal of approval. Now, according to Vince, the level of negativity in this market is downright stunning. First, I want you to take a look at the S&P 500 going all the way back to 1980 with data from the American Association of Individual Investors in blue. This is the percentage of bulls in their weekly sentiment survey, meaning the percentage of investors who think stocks are headed higher over the next 6 months. Last week, it was at 17.7%. You know, how low? How about it's one of the lowest readings in history. It's only a couple points higher than where it was in the spring, and that was the lowest level of bullishness since 1992. Even during the financial crisis, it didn't get that bad. As Vince sees it, anytime bulls make up less than 20% of the pie, you got to hold your nose and buy something. Next up, check out this chart, which shows the results of the same AAII survey. But this time, it's illustrating the percentage of investors who are bearish in red. Look at this. Last week, that number hit 60.9. I'm laughing because that's almost insane, all right? Meaning 6 in 10 investors see the market headed lower over the next 6 months. Vince points out that we haven't gotten a reading this negative since March 9th of 2009, which, by the way, if you recall, was immediately before one of the greatest bottoms I've ever seen, the so-called Haynes bottom, named after the late Mark Haynes, when everyone else thought the market was still going lower. When the bearishness gets this extreme, as it was here and here, okay, when it gets this extreme, it's often a terrific buying opportunity. I mean, we can see these buying opportunities, right? Look at these. Over and over again, we get these great buying opportunities. Well, I know that this is just about negativity, but figure it out. I know it's really hard to pull the trigger. We did so yesterday for the charitable trust. It was so painful. But that's why I got to tell you got to hold your nose and buy something, even if it makes you want to puke. History says it's the right call. All right, now take a look at this chart. This is of the National Association of Active Investment Managers Exposure Index, which measures the position of active risk managers. Basically reflects how long or short the average money manager is on U.S. stocks. It runs from negative to positive, with anything over 100 representing leveraged longs, borrowing money. Right now, though, the exposure index is at an anemic 29.59. Again, that's extremely negative. It tells you that institutional money managers have already gotten out. And look, it's not just the stock market. Now take a look at this. This is something I've been talking about for years. It's called the University of Michigan Consumer Sentiment Index. Vince notes that just one reading ago, it made an all-time, not 10-year, not 20, all-time record low for the Michigan consumer confidence. Even worse than the financial crisis. Even worse than the stagflation era. Consumers are really pulling in their horns. That tells you Jay Powell is winning his war against inflation and then some. All right, how about the consumer future expectations? According to data from the Conference Board, expectations about the next 6 months are at the lowest point since 2013. All right, now take a look at the Dow Jones Industrial Averages in black versus the 21-day average of the put-to-call option ratio in red. That's based on all the equity options on the CBOE. You buy call options when you're bullish, when you buy puts when you're bearish. So the lower this ratio goes, the worse sentiment has gotten. And right now, it's incredibly low. Not quite financial crisis low, because that was really pretty horrible, and then pandemic, okay, but pretty low. Again, Vince is pointing out that historically, when this ratio gets extremely depressed, it often heralds a bottom in the stock market, like we saw in 2009. How about volatility? Vince likes to look at the VIVIX, the VVIX, which measures the volatility of the CBOE Volatility Index, the VIX for short, and then divide that by the VIX itself. That's his preferred sentiment indicator, and right now, it's nearing where it was when the market bottomed in December of 2018. That was the last time Jay Powell went to war against inflation. He overdid it then. Maybe he's overdoing it now. Once again, the VIVIX to VIX ratio gets this negative. It's often a sign that we're ready to bounce. And you can see every one of these. Every time you see it bounce. Really, I don't think there's anything more clear than what this is saying about time to buy. Finally, I want you to take a look at this chart of the S&P 500 in black versus inverted net free credit balances in red. In other words, the red line shows how little money is sitting in margin accounts. These numbers are back to where they were in 2017, when the S&P 500 was more than 1,000 points lower than it is now. Practically anybody who was buying stocks with borrowed money has been blown out at this point. Isn't that fabulous? That's when it's the high, when there's so much money being borrowed, you know the market's about to crash. It's already done it. The bottom line, the charts as interpreted by Ralph Vince suggest that the investor sentiment has reached extremely negative levels, to the point where you got to hold your nose and buy something. I know that's hard to believe, even after today's magnificent bounce. But in every decline, you eventually reach a point where there's no one left to sell. Are we there yet? I don't know, but you can't rule it out after looking at these charts. I want to take phone calls. I want to go to Jason in California. Jason.
Hey, Jimmy, appreciate you having me on the show, man. Hey, I just wanted to say thank you for everything you do for us small-time investors. I know you get a lot of flack on social media when your calls don't necessarily play out, but you put a lot of insight and a lot of context to the market. You help small retail guys like me out a lot, so I appreciate that.
Thank you, Jason. Thank you. And, the people who are not in the arena, they make fun of me, and sometimes I read them and sometimes I don't. How can I help?
Yeah, so I wanted to ask you about Netflix. Had a huge day today, big pop. It's been consolidating in this 220 to 250 range for the last several weeks. If we can get over 250, it looks like there's a huge gap going all the way back to that dismal April earnings report up to 330. My question for you is, can we get there? What do we need to happen in the market to get us to that point?
What we need to see, and again, Jason, thank you for the kind words. What we need to see is that people really don't mind watching commercials. If they don't mind watching commercials, this stock is going to fly right through that level. I think that they will mind watching commercials. I don't like watching commercials. I think Netflix was set up against commercials, but I could be wrong. If I am wrong, this would not shock me. This stock has a lot of upside, because maybe commercials are tolerated by people who don't want to spend any money. Now I want to go to Pat in Washington. Pat.
Hi, booyah, Jim.
Booyah.
My name is Pat. I'm in Spokane Valley, Washington.
Fantastic.
I listen to you every day.
Thank you, Pat.
Thanks for all you do. I have some ConocoPhillips I've had for about 7 years. What's your thoughts on it now?
Well, I think that it's important to have oils that yield a lot. They give you a very good return. As they go below 80, people get very scared. My case is, listen, you got to own at least one oil. We have a market weighting in oil for our charitable trust. We cut it in half from what we had because they've had a big run. But right now, I don't want to sell anymore. Okay, the charts as interpreted by Ralph Vince suggested sentiment has reached negativity, extremely negative levels, and you got to hold your nose and you got to buy something. We may have reached a point where there's no one left to sell, and that point, of course, would have been yesterday's session. Much more mad money ahead. including my exclusive with the incoming and outgoing CEO of one of our absolute favorite stocks and a huge winner, Paychecks. From the state of small business to the executive transition, I'm covering a lot of ground with the company's top brass. Then today, investors seem to think that Apple was done for giving a headline on iPhone 14 production. But is the panic warranted? I'll give you my take, and believe me, it's certainly more informed than others. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.